Hey y'all, Austin Bratton here, your mortgage advisor. Today we're going to be talking about the differences between home equity line of credits and a home equity loan, and which one is going to be the best way for you to tap into the equity in your home without messing with your primary mortgage. A lot of people are locked in with these super low COVID clearance interest rates, as I like to call them, but other debts are piling up. Credit cards, auto loans, student loan repayments are kicking in. It means that there are a number of homeowners in America that are looking to tap into the equity of their home to consolidate some of these other high interest debts into a low monthly payment. Now, which one is going to be best for you and how do they work is what we're going to talk about today. So stay tuned. All right, first off, let's talk about the home equity loan. A home equity loan is a single disbursement second mortgage that you're able to take out on your property. Now, the benefit to a home equity loan is that it's going to be a fixed interest rate and a fixed repayment schedule ranging from 5 to 30 years, meaning you can stretch this payment out as long as you want. Some people are stretching them out all the way into 30-year terms, and this is a way to keep the monthly cash flow, the monthly minimum payment as low as possible to potentially refinance it later or just save as much money monthly right now as we can. Home equity loans are great for people that have a need right now, such as people that have home improvements to do, are paying off debt right away, or if you're trying to cash out to purchase another property and use that money as the down payment. The drawback on a home equity loan is it's a fully amortizing payment right off the bat. And there's no way to access additional equity above and beyond unless we do a new second mortgage or a new refinance as a whole. A home equity line of credit is a revolving account attached to your house. So it functions similar to a credit card in that you're able to charge the balance up and pay the balance down as needed and as able. The difference being it's attached to your house, so it's a secured line, meaning the interest rates are going to be way lower than your average credit card. And it's going to be an interest-only payment, typically for the first 10 years of the loan. Most home equity lines of credit, you have a 10-year interest-only payment period. So you're going to have super low payments because, hey, you're only paying interest for the first 10 years. After that, if you haven't paid it off already, it transfers into a 20-year repayment schedule. So it's a 30-year loan, but you're paying interest only for the first 10, and then there's a 20-year repayment schedule that kicks in at the end of that. Now, interest rates are going to be variable on home equity lines of credit. It's typically going to follow the prime rate. So the rates on these are normally going to be higher than your average conventional 30-year fixed rate primary mortgage. However, if we're averaging out a $500,000 mortgage with a 3% interest rate versus a $50,000 or $100,000 line of credit, typically you're still going to average out a lower interest rate than doing a full refinance. That's the benefit of these. We can secure these other high interest bills or tap into the equity without now having to pay a higher interest rate on all of the money you owe. Ideally, with a lot of these programs, people are expecting to be able to refinance and wrap it up in with their primary mortgage at a later date when the primary mortgage rates come back down again. But in the meantime, it's going to depend on you and your immediate goals for which one is going to make the most sense. Whichever one of these options is right for you is going to come down to you and your specific situation. There's one dear client of mine we're working on a home equity loan for right now. She chose the home equity loan because it allowed her to tap into the equity that she needed, pay off the bills she wanted to do, have a little bit of money left over to work on the house, and it's a fixed interest rate, fixed payment. So being a single mom, she wants to make sure there is zero uncertainty in her life if she can avoid it, which is why we're doing this program specifically for her. I have another client that was doing a home equity line of credit, And with them, the home equity line of credit allows them to have a maximum line above and beyond what they're borrowing. We ended up writing a $50,000 initial draw. They initially got $50K to pay off their bills, etc. with, but then there's about $16,000 left over in the line of credit. That's the perk to the line of credit, is if you don't have a big need for all the money right now, you can have that maximum line amount available for a later date. In some cases, people can use a line of credit to help offset seasonal expenses. For example, if you're going into like a slower period of work or something like that. In other cases, with this one specific family, they had other expenses later on they might be taking on, like going back to school. So, hey, we'd like to be able to tap into the equity if we need to, but we only want $50K right now to be able to pay off XYZ bills. The flexibility there with the home equity line of credit really is the big perk, because it's not that the interest rates are cheaper on a line of credit than they are on a home equity loan, but it's the additional flexibility that you get of both having the interest only payment, so the payment might be a little bit cheaper depending on your qualifications, and the ability to have a maximum line amount you're not drawing on yet, which means you're not paying on it yet. The other benefit with a home equity line of credit is it's its own snowball effect. As you're paying it down, the payment is gradually decreasing as well, because the payment is based on your active balance. So when your tax refund comes in, you chunk a big check to the home equity line of credit, pay that thing down, your monthly payment is now going to be cheaper as well, because less money owed. If you or someone you know might have questions about how to tap into the equity on your home, pay off some of these high interest bills, or just want to know more about mortgages and how they work right now, I'd love to chat with you. The link is going to be in the description of this video, and I hope this was helpful. If you found it helpful, please like and subscribe to the channel. More good information is coming. Hopefully we're going to be able to get a lot more videos out before the end of the year. I look forward to bringing you some real value and showing you how things work around here. Thanks.